This video is a quick demonstration of how to do the first few exercises in Chapter 7. We'll start with Exercise 2, where we're asked to use an existing template that we're given to build a financial model. And we're asked to assume that a WACC is 20% and value the company's equity. That means we need to complete the income statement and the balance sheet so that we can get to free cash flows and then discount those free cash flows at 20% to get the company's equity. So let's start with the template that we're given. And with this template, we are given some model parameters, one of which is sales growth. So sales growth is 10%. So we're given last year's actual values and asked to forecast the next year's values, and then we'll copy that over for 5 years. So to forecast sales, we'll simply take the previous year's sales times 1 plus the growth rate. Cost of goods sold, we are told, is equal to a negative 50% times sales. Interest payments on debt, we are told, is equal to a negative interest rate on debt times, we're going to use the average debt balance. We could have used last year's debt balance, we could have used this year's debt balance. We're going to use the average, quite honestly, because that's the way that the solution in the book approaches it. Different people do it different ways, but using the average debt balance gives us the most accurate reflection of what debt is this year. It's the average of what it was at the beginning of the year and the end of the year. You need to lock that interest cell. Similarly, we will look at the interest earned times the average cash balance. Of course, these are blank, but when we fill them in, the formulas will update. Our depreciation, I'll put in a negative sign, is 10% times the average fixed assets at cost. And what that is the cumulative fixed assets that have ever been invested in by the firm since the beginning of the firm's existence. Again, we want to use the average of the beginning of the year and the end of the year. Our profit before tax is the sum of all the items above, and the shortcut for that is alt equal. The taxes are negative tax rate times the profit before tax, and the profit after tax is the sum of the two items above. The dividends are negative dividend payout ratio times the profit after tax, which is simply saying we're going to give 40% of those profits back to the shareholders as dividends, and the remaining amount of that will flow to the balance sheet as retained earnings. Moving to the balance sheet, cash is the plug in this item, because if we think about everything else we're given, cash is the one that we're not given. And as he outlines in detail in the chapter, the plug is the number which would make the total liabilities equal to the total assets. So if we subtract off the net fixed assets and the current assets, then this number plus this number plus this number will have to equal this number, and our balance sheet will balance. Current assets, we're told, are also a function of sales. And we're told that net fixed assets are a function of sales. In the next problem, he'll approach this differently, but in this problem, he tells us to assume that it's a function of sales. Accumulated depreciation, which means all the depreciation over time, is equal to whatever it was in the previous year plus whatever depreciation we had this year. Therefore, net fixed assets at cost must equal net fixed assets plus accumulated depreciation. Minus. Our current liabilities, we are told, are a function of sales. stock we're going to hold flat, and debt we're going to hold flat. Set those in reversed order. And accumulated retained earnings are simply what they were before plus the retained earnings from above. And we can sum those up to get our total liabilities and equity. Don't think we summed our total assets, so let's do the same thing there. Can't just hit Alt equal here because it's the cash plus the current assets plus the net fixed assets. And our balance sheet does in fact balance. I'm going to fix the number format using the format painter from this cell so that they all look the same. Now if I got all the dollar signs right, I should be able to copy across the next few years. And that's the same answer we got in class, and it in fact matches the solution. So we've now projected our income statement and our balance sheet. Let's move down to free cash flow. For free cash flow, we simply bring down the profit after tax from row 22. Now depreciation is something that we need to add back. So it was negative up here. We need to add it back in as a positive. Subtract the increase in current assets. So since we're subtracting, I'll need a negative sign. Add the increase in current liabilities. Subtract the increase in fixed assets at cost. Requires a negative sign in front. Add back our after tax, so 1 minus the tax rate. Interest expense. And then do the same with interest earned. And the sum of those should give us free cash flow. We needed a negative sign so that we could add back the after-tax interest on debt. And we in fact get the correct number. Now that we have free cash flow, we can forecast that forward. And we have something to discount. Before we go there, let's talk about why we did what we did in this section. We began with a profit after tax, which is an accounting number. It's an earnings type number, which reflects things like depreciation. Nobody wrote a check for $117,000 in depreciation. That's just what we counted from a book standpoint. So we want to reverse that number back out. Similarly, in current assets, even though it doesn't show up on the income statement, somehow the firm invested cash in current assets to cause them to grow from 150 to 165. So wherever that cash came from, that 15 of cash needs to be taken out of free cash flow. And in the same way, if our current liabilities increased, that was cash that we didn't pay, but we'll need to, and we need to add that back into cash flow because it was reflected in earnings, but wouldn't be reflected in free cash flow, so we need to add it back in. The increase in the fixed assets at cost is presumably $194 or $1 million of investment that we made in PP&E, for example. Didn't show up in earnings directly, So we need to take that out of our cash flow because it was paid for in this year. Interest on the debt is an expense that we did show in our profit after tax, including its tax benefit. However, that's money that was paid to the debt holders of the firm, and so it shouldn't show up in free cash flow to the firm. So we're going to add that back in. And then the cash that we earned on our cash and marketable securities was also a financing activity analogous to interest that we paid on debt and shouldn't be taken out of free cash flow to the firm. So that gets us to the 176. Now let's bring these numbers down to our discounted cash flow section, bringing them straight from above. And we're calculating a terminal value. This is something we did a lot for exam 1 and something that he gives the equation for, the formula for in the chapter. And the formula is simply the final cash flow times 1 plus the growth rate. So this is a terminal value perpetuity calculation, 1 plus the growth rate over the discount rate minus the growth rate. That formula is given in the chapter. It's the same as we used in exam 1. What's a little bit different than exam 1 was we kind of assumed that would be out here in year 6 for simplicity. We're going to firm that up and put it in year 5 to be more accurate now. And then we'll add up the actual cash flows with the terminal cash flow. And we'll get 5 years of cash flow that represents all the future cash flows of the firm. We can discount those numbers back to time 0. Now here's the big difference in what we did in exam 1. If you look at the NPV formula that we're using here, we're discounting by WACC, and we're looking at years 1 through 5. We're not pulling year 1 out because we want a full year of discounting on year 1. I stressed in exam 1 that NPV discount the first value you give it, but since the first value we're giving it, we're assuming is at the end of year 1, then we're okay with that. So that's the NPV of the cash flows. Now the firm today already has some cash. If we add that to the value of the future cash flows, then we get the enterprise value of the firm, and we have some debt. So if we subtract that out, then we get what is the value of the firm to the equity holders if we used the cash and paid off all the debt. What would the value we have left be? Another way you can look at that is just take the cash and the debt and call it a net debt of 240. So take the value from our NPV minus the net debt to get the equity value. It's the same thing. He's just showing us twice a couple of different ways to do this. Now I said up here we were assuming the 176 happened at the end of the year. If it happened at the middle of the year, how would we adjust for that? Well, we could actually adjust all of these numbers to be reflected at the middle of the year instead of the end by making them a little bit bigger. And we'll make them bigger by the amount of, hard to show on there, by the amount of the WACC over half of a year. So if we take the NPV, multiply it by 1 plus the WACC to the exponent of 1/2 of a year, it increases it from 1598 to 1750. So he's showing us 2 ways to value the firm, one with it at the year end, one with it at the mid-year. And then again, we subtract off the net debt to get to the equity value. Since we're not given a share count in this problem, this is actually the end of problem 2.